Hi there, eToro. I can't make my video this coming Monday. I've just got too much going on, and so I'm bringing it forward to today. Let's take a look at what happened in the markets this week. Looking at the stats, the comparison feature within eToro's charts is working again. The numbers here aren't exactly correct because of the period being shown in the chart right now, but for the trailing 12-month period, the S&P 500 has put in a return of 39%, whereas my portfolio has put in a return of 42%. The 1 week returns don't include today's numbers just yet. I would have to wait until the market closes, and that's too late. So the numbers are slightly skewed, but in terms of the best performers, it's pretty much a mixed bag in terms of the companies that have done the best through the past week, whereas the predominant losers within the week tend to be Chinese businesses. So Chinese companies had a bit of a rally 2 weeks ago or 3 weeks ago, and it seems that rally has cooled off a bit. I also think that investor focus has shifted a little bit away from Chinese stocks for now and towards European and US stocks because of the earnings that are currently going on. There were some interesting bits and pieces of data, but starting with the UK, we had not a lot in terms of data, but we did have the autumn budget. I started highlighting things in yellow, but actually the summary has a lot of very interesting points, all of which I would invite you to read through if you are investing in the UK. As always, the budget is controversial. There's quite a mixture of different things. The government is increasing spending in some key areas. I think that is good. A lot of those areas are areas that have suffered from underinvestment through the past few years. The critics are saying that investment is just returning to where it was pre-austerity. But if that's the first step in funding ultimately increasing beyond pre-austerity levels, then so be it. There are a few things in there that are head scratchers. I'm not sure why they're part of the budget at all. There are some really good things, so ongoing support for for businesses in certain sectors. Overall, I think it was a decent budget. I don't think they knocked it out of the park. There wasn't anything particularly shocking in there. They could have done better, but I think they also could have done worse. I invite you to read through this. I know that opinions will vary. I meant to bring this chart up before, so this runs. I don't think this runs up until the most recent set of corporate profits, but as you can see, United Kingdom corporate profits have been rising fast through the past year or so after the tumble of 2020. The strange thing is that despite corporate profits rising this quickly, as we all know by now, because I complain about it so much, stock prices have remained depressed, and that's because of sentiment. The stock market prices are driven by sentiment in the short term, and tend to be driven by fundamentals in the long term. So the fundamentals are actually quite strong, and we've seen a bit more of this through the earnings in the UK and parts of Europe. So many businesses in the UK have done very, very well. So the financial companies in the financial sector have done particularly well, but there are others that have also done fantastically. And by the by, it seems that business is fairly strong within the UK right now. So again, we have to be patient when it comes to UK stocks, but there are some very strong businesses that are doing very well, and they are very cheap because I think that they are out of the sentiment towards the UK at the moment is a bit meh. Moving on to the US. So I've got a collection of indices and ETFs here on screen, and I'm just looking at this 1 week performance. So you can see that the KWEB ETF, Chinese Internet Technology, is down 6% for the week. But we can see that, for example, the NASDAQ 100 has done pretty well. S&P 500 has done pretty well. But the strange thing, and it's perhaps a bit more obvious if we look at this chart, is that the performance has been very spotty. We haven't seen breadth in the rally within stocks, particularly on a handful of days through this week. So the big companies that did very well through earnings have pulled indices higher, whereas a very large number of the other constituents of those indices or ETFs haven't done very well at all. So what I wanted to point out here is that the S&P 500 and NASDAQ 100, which are dominated by the mega caps that we all know by now, the FANGs, or now they should be called the MANGs. We can see that the Russell 2000, which is 2,000 smaller companies in the US, didn't fare anywhere near as well through that same period. So there's been an uneven boom in stock prices, and that's usually not a good thing in the short term for the stock market overall. If you see a rally, you want to see it across the board, because it means that the market is truly in a bull market. So I don't know if we're going to see a bit of a wobble, but I'll talk about that in a moment. So we've glanced at this heat map already. Yesterday we saw a rally just about across the board, and so that's really changed the way that this chart looks. The 1 week perspective, we can see that performance has been spotty and driven almost entirely off of earnings, although I guess Tesla is probably the exception to that. They didn't really pump on earnings so much as the announcement of their deal with Hertz. But we can see that Facebook, Twitter, they have been hit hard by poor earnings, whereas Google, Microsoft have done better. Apple reported earnings last night, and Apple's going to be red today. So not all companies in this chart have reported just yet, but some of the ones that are deeper red or deeper green, they have been influenced by their earnings. Now, the thing is, you probably shouldn't buy or sell based on a single earnings report. Companies that have long-term strategic outlooks, there might be one or more quarters where they do things that hurt the actual earnings report of that quarter. And this might be because there's something going on that they need to deal with. For example, Amazon's earnings report last night was a miss, a pretty large miss, but it was because they're trying to maintain business levels. And that means in order to do that in an environment where there are heightened costs around supply chains and shipping and employment, they need to invest more heavily, more money, take more of the profits and pump them into those areas in order to sustain the quality of business that we all know Amazon to be. So you don't necessarily want to trade a company because of a single or even multiple earnings reports. Sometimes you might want to, but you should read each earnings report and also go back to whatever your plan was for that particular company and read the earnings report within that context. So through this year, the market has been climbing a wall of worry. It's not my term, that's a term that's been used by a number of analysts. And despite this wall of worry, all these things that we need to be concerned about, companies continue pumping out higher earnings or great earnings, and stock prices keep on going up. So there's a great post at the moment on the SPX 500 feed with an etoro talking about how 85% of the S&P 500 companies that have reported earnings so far have reported positive EPS surprises, and 75% of the companies that have reported positive revenue surprises. So yes, we've seen some pretty large misses, but by far the larger proportion of companies have been reporting excellent growth in earnings and revenue. So I encourage you to read this kind of content. It can create some perspective, help you see the forest for the trees, or the trees for the forest, or both. We have, however, seen some misses by some large companies. Either they missed in this earnings report, or their forecasts weren't fantastic and the market is punishing them at the moment. So there are a few examples. Amazon has grown, but their earnings was a pretty large miss, even though they set expectations down earlier in the year, and they've tempered expectations for the rest of the year. But again, I encourage you to look beyond the headlines, look into the details, because there is some good information, good news in the details of Amazon's earnings report. And if Amazon's going to have a rubbish quarter through Q4, or not rubbish, less good than it was in Q4 2020, but it's going to return to the business, the kind of growth that it saw through next year, do you really want to be out of Amazon stock for that? A number of companies, Alphabet and Google, have done very, very well. Their share prices reflect how good their results have been as well as their forecasts. But again, it has been, as I've been saying, pre-earnings season this time around, results were probably going to be lumpy. Another thing that I have been saying, and I had a call with my some of my copiers yesterday, is that I have bought stocks or increased my position in stocks expecting something of a Santa rally in particular sectors within the economy. But I also know that Q4 last year was exceptional. And this is for a few reasons. There was a lot of pent-up demand. People couldn't buy services, so they overbought products. There were a lot of savings. There was a lot more money sloshing around in the various economies. So people spent a lot of money, a record-breaking amount of money through Q4 last year. I think that this Q4 is also going to be very, very good. Whether it's going to be better than Q4 last year, that remains a question to be seen. I kind of expect it not to be as good as last year, but still fantastic for the types of businesses that usually benefit from the Santa rally towards the end of the year. I wanted to talk about this chart very quickly. So this is from Twitter, by the way. You can see the man who's posted this chart on the top right. I don't know how to pronounce his name, ᴜᴘᴅᴏᴍ. And we can see that this is a chart that spans many decades. And it looks as though we have hit peak earnings growth, and that earnings growth is starting to slow. Now, the point of this particular chart is that the market tends, and this is the S&P 500, by the way, the market tends to have a little wobble, what is called a wobble here, whenever peak earnings growth is experienced. And so the question is, the sell-off that we saw through September, was that the wobble that we're going to see for this round of peak earnings growth, or is there more to come? And nobody really knows, but it's good to have this kind of background information as well as a view on what happens historically. So peak earnings growth doesn't mean that growth stops. It just means that the rate of growth starts to slow down over time. This is obviously cyclical. This follows the business cycle to some degree, or other sub-cycles to some degree. And so we can see that the worry about having experienced peak earnings growth usually causes some of a wobble, but thereafter the market tends to continue its rally. This signals usually that you are in the middle of the business cycle. So you're in the middle of that bull run. I wanted to bring this up. It's always a good reminder to, again, this is a forest for the trees kind of perspective. So again, this is the S&P 500 total returns, and this is from 2009 all through 2021. And here we can see all of the different fears, big fears, I would say, that have struck the market through this 12-year period. And despite all of these concerns, the market has continued to run upwards. Now, of course, there are lots of points at which the market pulled back or even dropped into a bear market. But ultimately, as the world continues to grow, global GDP continues to grow, the stock market marches upwards. So just remember that if there is a wobble, it is probably going to be short-lived. At longest, it'll be a few months. As I said earlier, investors at the moment tend to be focused on earnings. And so Chinese markets aren't the thing that are making the biggest headlines at the moment. This article, I guess, is negative about the risks that are starting to multiply, which is strange because if you read the content of this article, it's saying that the markets have been slammed for many, many months, even up to a year at this point in time, and that investors have probably priced in just about everything that could possibly go wrong and then some. And now analyst sentiment as well as investor sentiment, all those retail investors that I mentioned last week that make up the Chinese market, the way that they feel about Chinese equities feels like it's beginning to turn. It is probably going to be a volatile journey upwards. So maybe strong up and downs along the way. But there are lots of opportunities. And if people are feeling less negative towards the stocks, I think that they will begin seeing net inflows again. Of course, there are still quite a lot of concerns around China, political, economic, etc. So we do need to be quite careful. But if you have a long-term view, in my opinion, Chinese stocks can be multi-baggers in many, many instances. All right, on to the rest of world segment of the video. So solar stocks jumped massively through this week, which had me kicking myself a little bit because, as I mentioned, I sold out of my solar edge positions at a decent profit. But the solar edge jumped, I think, 10% this week. But that's okay. You can't capture every little bit of green that your stocks encounter. So this was driven by earnings from Enphase Energy, and Enphase itself went up in double-digit percentages and pulled up the rest of the market. I do wonder if the stock market, if investors have gotten a little bit ahead of themselves, because I know that solar stocks have been downtrodden, but they have recovered quite a lot over the past few months. There are some really good opportunities in the mix, but some of them are starting to look expensive. And now with a big jump that happened this week, if any of these big solar stock report negative earnings next week or the week beyond, I think we could see another bit of a tumble. I did want to mention that I have spent some time with consultants in the solar industry through the past few months, and the opinion that most of them share is that the companies that serve the consumer side of the market, so panel installations on houses, will have been less hard hit by supply chain issues and increases in material costs than the companies that build out solar projects for other companies or for the utilities within a country. And the reason for this, the theory goes, for the companies that are serving the consumer side of the market, probably the largest part of their cost is labor. So they don't need as much equipment as the bigger corporate and utility scale projects need. And so the cost of equipment is less of a concern, and sourcing materials is less of a concern. It's more about paying for the people to do the installations. Whereas the bigger projects need a lot more stuff, are far more complicated in their setups. And so the costs of the equipment make more of a material impact. So we'll see whether that theory plays out as the rest of the solar companies report earnings through the coming weeks. I mentioned Brazil is in a bit of a jam at the moment, and so the president is still in a bit of trouble, and the central bank has raised the interest rate by 150 basis points, which is a bit crazy, but inflation is very high there at the moment. We can see that the Brazilian index ETF is sitting at the low levels that it set last week. So still not sure that this market has bottomed. We will know within the next few weeks. In terms of earnings, so we saw many of the mega caps reporting through this week, but earnings season is far from over. There are lots of companies, so November 1st through November 5th, lots of companies reporting next week. Many of these companies I'll be very interested in what they have to say. So companies such as Activision, Alibaba, Square are all in my portfolio. But there are some stocks that are not in my portfolio that'll be interesting because I want to know what they're saying about the sector overall. We also have COP26 kicking off this week on Sunday, and then that runs for nearly 2 weeks. So this is the United Nations Climate Change Conference. This is where the talking heads, so a number of powerful people from around the world will come together to talk about how individual countries and organizations might help us achieve our climate change goals through the coming years and decades. I think there'll be some very interesting developments, and I'll be watching this very closely. And finally, we will get some interesting economic data out of next week. So lots of PMI data from China, the UK, the US. We'll also get some interest rate decisions out of the US and the UK. So lots of potentially market moving data next week on top of earnings. So I think it might be quite a week depending on the kind of data that we see. All right, that's it for my review of this week that's just gone. I won't talk to you next week, but I'll talk to you on the Monday following next week. If you are at the Web Summit in Lisbon next week, please come along to eToro's booth. I will be there on the 2nd and 3rd of November, I'd be happy to shake your hand and have a chat. All right, that's it for today. Speak to you soon. Goodbye.